Something major just happened in California, and it could quietly reshape the future of self-driving cars in the United States. Tesla, the company that's promised a world of cars that drive themselves, is now facing the possibility of being banned from selling vehicles in its biggest U.S. market. Not because of a crash, not because of a recall, but because of the words it uses to describe what its cars can actually do. Here's what just happened, in simple terms. California's Department of Motor Vehicles says Tesla has been misleading customers about its autopilot and full self-driving features. According to the state, Tesla's marketing made drivers believe their cars were far more autonomous than they really are. After months of hearings and testimony from autonomous vehicle experts, an administrative judge agreed. The ruling says Tesla's systems still require near-constant human supervision. They are not robotaxis. They are not cars that can safely drive themselves without attention. And yet, the names and descriptions Tesla used suggested something much closer to full autonomy. As a result, the judge recommended a serious penalty: a 30-day suspension on Tesla's ability to sell new vehicles in California. That would be unprecedented in the U.S. For now, the DMV is holding off. Tesla has been given 60 days to change how it markets autopilot and full self-driving. If it does, the ban goes away. If it doesn't, Tesla could be locked out of new vehicle sales in California for a month. Production at its Fremont factory would continue, but sales would stop. California officials say this isn't about punishing innovation. They say it's about safety, honesty, and protecting drivers, passengers, and pedestrians in a state that leads the country in autonomous vehicle testing. Tesla hasn't responded publicly. So why does this matter so much? Because this goes far beyond one company and one marketing dispute. California is Tesla's largest U.S. market. A 30-day sales freeze there wouldn't just be embarrassing. It could cost the company tens of millions of dollars in lost revenue at a time when Tesla's electric vehicle sales are already slowing. But the bigger issue is trust. Self-driving technology sits at a fragile intersection of innovation and public safety. Regulators are trying to figure out how to encourage progress without letting companies overpromise and put people at risk. When consumers believe a car can do more than it actually can, behavior changes. Attention drops, risk increases. And when something goes wrong, it's not just the company that pays the price. It's public confidence in the entire industry. This ruling also highlights a growing divide in how autonomy is being built. Tesla relies on a camera-only system, avoiding LiDAR and radar that other autonomous vehicle companies use to see depth and operate in poor lighting. That low-cost approach is central to Elon Musk's vision of scaling self-driving quickly, but experts testified that this approach still requires drivers to stay alert at nearly all times. That's a critical detail, because Tesla's long-term vision depends on convincing regulators, investors, and the public that its technology can eventually power a robotaxi network. And that brings us to who wins and who loses. Regulators gain leverage. California sends a clear signal that bold claims won't be tolerated if they outpace reality. Other automakers and autonomous vehicle companies, especially those that have taken a slower, more conservative approach, may quietly benefit. Companies like Waymo, which already operate tightly regulated robotaxi services, now look more aligned with how regulators define autonomy. Consumers also gain something important: clearer expectations. If Tesla changes its language, buyers will better understand what they're paying for and what responsibility still sits behind the wheel. Tesla, on the other hand, takes a hit, not just financially, but strategically. This challenges one of the company's most powerful narratives. Investor excitement around self-driving technology has been a major driver of Tesla's valuation, and just days ago, the stock hit an all-time high. That optimism rests heavily on the belief that Tesla is close to cracking full autonomy. This ruling suggests regulators aren't convinced, and Elon Musk's vision of a massive robotaxi network now faces sharper scrutiny. Tesla has begun offering paid rides in Austin, but those cars still have human safety drivers. Fully autonomous testing is underway, but without paying passengers. The gap between aspiration and approval remains wide. So what could happen next? The most likely outcome is that Tesla adjusts its marketing language. The DMV itself said the company can resolve this issue with relatively simple changes. If that happens, sales continue uninterrupted, and Tesla avoids an immediate financial hit. But the precedent remains. Other states may look closely at California's decision. Federal safety investigators are already expanding their probe into Tesla's full self-driving software. This could mark the beginning of more aggressive oversight, not just of Tesla, but of how autonomy is sold to the public. It also raises an uncomfortable question for the industry. How close is close enough to call something self-driving? As technology advances incrementally, the line between assistance and autonomy becomes harder to define, and regulators are signaling that they intend to draw that line clearly. Moments like this don't dominate headlines forever. They don't arrive with dramatic crashes or sweeping bans, but they quietly shape what comes next. How companies describe their technology, how regulators enforce boundaries, and how the public learns to trust or doubt the promise of a self-driving future.